A very good morning. Welcome to today's episode of Morning Wealth. Wishing you a fabulous Friday ahead. We'll talk about three things. Powell's could cause some upward pressure on prices comment. OPEC Plus agrees to keep a lid. US dollar traded sharply higher. Wednesday's big tech slide extended into a second day as momentum continued for a rate driven stock rotation. Federal Reserve Chairman Jerome Powell's comments on Thursday, such as that an economic reopening could cause some upward pressure on prices, appear to unsettle the market. Benchmark 10-year Treasury yields jumped another 7 basis points to 1.55, the highest since mid-February last year. Seemingly in tandem, technology stocks once again took it on the chin. PayPal, Tesla, Twitter all down more than 5%. Interestingly, an exchange traded fund focused on stocks popular in social media with the ticker Buzz fizzled on its debut. The Nasdaq was down 2.1%, the S&P and the Dow Jones fared better, down 1.3 and 1.1% respectively. Meanwhile, energy stocks experienced another rally as a group of oil producing nations agreed to keep a lid on production and lifting oil prices. OPEC Plus is in fact mimicking Powell by sticking with its strategy. The group agreed to keep a tight squeeze on output through April, and Saudi Arabia said it will maintain its 1 million barrels a day voluntary cut. While the Saudis restraint won out, the Russians and Kazakhs again got exemptions to the agreement, this time for 130,000 and 220,000 barrels a day, respectively. The surprisingly bullish outcome sent crude prices soaring. Contracts were up more than 4% in New York and London as WTI climbed above $64. This led the S&P energy stocks jump by about 2.5%, just about the reverse of information technology stocks. Diamondback Energy led the S&P 500 with a 9% increase. On to US dollar, a lot happening there. The US dollar traded sharply higher against all of the major currencies after Federal Reserve Chairman expressed little to no concern about the recent spike in yields. In fact, in terms of trickle down, the benchmark 30-year mortgage rate, for example, rose above 3% for the first time since July 2020. Interest rates are still low, but refinancing and demand for new homes will ease if mortgage rates continue to rise. The US dollar benefits in a few different ways. Powell's confidence in the US economy and its ability to weather the increase in rates is good for the dollar. The higher, more attractive yield also draws demand for the greenback, and most importantly, the slide in stocks drives investors into currency safety. Dollar yen jumped to its strongest level in 8 months after Powell's comments, which is basically tracking the rise in US yields, while the dollar CHF rose to its highest level in 4 months. Just a point here. It's important to understand that Powell's relaxed outlook on inflation and yields comes from a place of optimism. Powell said, "We expect that as the economy reopens and hopefully picks up, we will see inflation move up through base effects. That could create some upward pressure on prices. There's good reason to think that the outlook is becoming more positive at the margins." Powell also didn't see a reason to take steps to stabilize the bond market and stem the rise in yields. The big question now is whether today's non-farm payrolls report will add or ease the dollar's gains. Based on yesterday's rally and the pre-Powell gain in stocks, investors are not concerned about a weak jobs report, you could say. Over the last 2 months, the job market has been very weak. 227,000 jobs were lost in December and only 49,000 jobs were recovered in January. Economists are looking for a strong recovery in February, with US companies adding more than 180K workers. There's no question that the manufacturing job market is hot, but the services sector is slowing and it's been slow to pick up as well. Yesterday, we learned that the non-manufacturing ISM index dropped from 58.7 to 55.3 in February, with the employment component falling to 52.7 from 55.2. ADP also reported weaker payroll growth. There are reasons to believe that more jobs were created in February, but the deterioration in these two key measures suggests that payrolls could fall short of expectations. Weaker jobs data would compound the slide in stocks and sell off in risk currencies. Ironically, this means it could be positive rather than negative for the dollar because ultimately the US economy is on a path to recovery. This will be an interesting dynamic to watch out for later this evening. Let's see how this plays out. That's the update. Stay safe and healthy. Have a lovely weekend ahead, and I'll speak to you on Monday. Thank you.